So allow me to make a round of introductions. Let's start with you, Melanie. Melanie Rieback, you are an entrepreneur. You are the CEO and the founder of Radically Open Security. That's a not-for-profit computer security company that you founded in 2014. And you are also the co-founder and CEO of Non-Profit Ventures. So that's the world's first incubator for post-growth startups. So that's businesses who want to basically embrace a post-growth entrepreneurship model. That's where the measure for success is impact and not profit. So over to you, Philippe. Philippe Zaouati, you are the founder and CEO of Mirova. Mirova is an investment management firm that is dedicated to sustainable investment and impact investing. You now have 30 billion euros in circa 30 billion euros in assets under management. So part of it is invested in private assets with directly invested in solutions with a deeper impact focus, and some of it is invested in public funds, so with a more broad, sustainable lens. You've been very involved in building the impact investing ecosystem for the past 10 years. Just for our audience, when we talk about impact investing, it's the idea of investing with the view of having a positive social and/or environmental impact, and at the same time still make financial return. So that's just so we know what we're talking about. Erinch Sahan, you are the business and enterprise lead at the Doughnut Economics Action Lab, where your work focuses on transforming the design of businesses to enable them to pursue regenerative and distributive strategies. So Doughnut Economics, it's a very, very interesting model. I invite you to look it up online. We don't have time to explore it fully today, but it also has this idea of providing for all without overshooting planetary boundaries, hasn't it? You have led the development, in particular, of the Doughnut Design for Business tool. So that's basically to help businesses to engage with the concepts of Doughnut economics. So thank you, three of you, for being here with us today. So I'll start with you, Erinch, with a question. What do we need from business to pursue this beyond growth model?
Is this working? Oh, yes, I'm here. Hi, everybody. Wonderful to be with you. And what an amazing speaker Timothy is, isn't he? I mean, that was just inspiring. And I think the answer to the question actually began in Timothy's talk. He talked about making sure that businesses can make those decisions, take those strategies that allow us to meet the needs of people within the means of our living planet, within the biocapacity that we have. And what we have found at Doughnut Economics Action Lab is that working with several hundred businesses, when we ask those questions of what is needed from business, what is needed from them in terms of actions, investments, strategies, we come up with some really big ideas. Ideas like agroecology, ideas like circular economy, modular product design, ideas like paying enough to your suppliers so that the people in the supply chain can earn a living income or a living wage, paying a fair share of tax so that you're not trying to minimize your tax, but you're paying actually what would be your fair contribution. When you put those ideas on the table of most businesses, what we find is that the business is limited by their own design. They're designed to extract as much profit as possible. They're designed to pursue specific, rigid margin requirements. They're designed to only enable internal reinvestment if it's going to produce a high enough return to satisfy their investors. All of these design choices we've made in business has meant that the businesses around the world are held back. So we've got a huge amount of energy, a huge amount of interest piling in to the win-wins, piling into scenarios where, yes, by doing good, you will also produce a very high return. And that is the minority of the actions needed. The majority of the actions needed actually mean that we're going to test the design of our economy, we're going to test the designs of our businesses. Critically, we're going to test the design of finance. So to make all of this a reality, to unlock those actions that are regenerative, that are working with and within the cycles of the living world, and that are distributive, that are actually sharing value far more equitably with all who are co-creating it, we're going to need to reconsider the deep design of business and bring in big new ideas like steward ownership, where a foundation owns the company, reinvest the majority of profits, social enterprises where the majority of profits are reinvested into the business. Examples like post-growth entrepreneurship that Melanie has pioneered and has created an amazing course and journey for entrepreneurs. Examples coming out of the cooperative movement, hybrids that are emerging, new design models, putting nature on the board, putting workers on the board, bringing in new economic democracy into the model of businesses. These are the designs of companies that unlock the actions, the decisions needed for us to transition in the way that Timothy discussed, that we, all of us, I think, realize we need. But it's a scary transition. It's a scary transition, Laura, because it means we need to leave behind those 20th century, the old 20th century models of business, finance, investment. And while they're producing a few, solutions here and there, they're not getting us anywhere near far enough. We need to redesign all of these institutions, structures, markets to unlock the actions that we need.
Great. And just to pick up on something, like these new models, some companies are already embracing them, aren't they? It's not just something we're dreaming of.
Absolutely. They're doing it actually within an ecosystem that is not designed to support this. They're doing it despite the policy ecosystem. They're doing it despite the financial system that surrounds them. So these are the companies that are absolutely beginning to pioneer solutions. Examples like Einhorn, that makes vegan condoms based out of Berlin in Germany. Well, they have a steward ownership model. They have a holocracy model within management. This is unlocking a whole host of really innovative ideas. I mean, examples here as well that I've met of businesses that are putting nature on their board. Faith in Nature is doing that. They're putting Lawyers for Nature as a representative, a voting board member. Nature, Earth has a seat on their board. Examples that have got multi-stakeholder models, examples from around the global south as well, around the world, in India, examples like Last Forest or Sasha or Creative Handicrafts that are worker-owned factories. We've got all sorts of enterprises that are absolutely emerging around the world, and we can supercharge this. We can really accelerate the transition if we are deliberate in redesigning finance to be in service of those businesses, which are in service of nature and in service of society, and redesigning businesses so they fit the realities of the 21st century.
Great. So redesigning finance, Philippe, I'm going to turn to you. So how can finance be not a barrier, but an enabler for this kind of change? What kind of changes are needed? A lot, but is that possible?
Oh, we need urgently to dismantle finance. No, I mean, as Erinch just said, the system itself, by nature, is linked to growth. Finance is linked to growth. All the way it works. I mean, it's very short-term decisions, and all the organization, the behavior of the market players is oriented to growth. When you calculate the value of a company, what do? You discount the future cash flows. That means that you are just measuring the future growth of the company. So it's embedded in finance. So the question is, what do we do? I mean, should we completely change and dismantle finance and use something else? The problem is that this is today the fuel of all the economy. So we have to use it, and so we have to use it as in judo, like, you have to use the strength of the people you are fighting with. Mm-hmm. And I think it's exactly what we have to do with finance. And today, yes, of course, there are new models, social economy, and also what we call impact finance, which is the equivalent of social economy, I would say, in the finance world. But it's very small. I mean, Mirova, you mentioned it. It's 30 billion euros today. So 30 billions seems to be a lot of money. It is a lot of money. But if you compare it to the big asset managers of the world, in Europe, I mean, the biggest one managed 2,000 billion euros. In the world, BlackRock, with the world leaders, managed 10 trillion euros, 10,000 billion euros. So that means that we are still only a very little part of this. And the problem is that green finance, impact investing, I think it's very good. It's something, I mean, there are a lot of very sincere and committed people, and I hope that we are a part of this community. But at the end of the day, all we have done these last 10 years is just adding some layers on the top of the system. And even in the regulation, all the regulation that has been created these last 10 years is about creating new markets, the green bond markets, sustainable fund markets, and special labels, and so on and so forth. But the heart of the system has not changed a lot. So we are still working in an environment which is really very difficult for us to live with, and so we have to use it very smartly. But the good thing is that it gives to the finance industry a huge responsibility. As by nature, it's clearly technically impossible to do create a sustainable economy with the finance as it is today. That means that the finance players have to make some very strong choices. So of course, there is a link between growth and finance. But that means that we must not invest in everything. That we have to choose very clearly to invest in businesses, teams, companies which are providing products and solutions which are within the planet boundaries. Yeah. So yeah, the more you have power, the more you have responsibility, and that's exactly the situation where we are today in the finance industry.
Well, I'd like to bring in Melanie now. You are helping startups to embrace this new model. I'm sure there are a lot of startups here looking to raise VC investment and are probably very worried about losing their soul, right? So, from your point of view, finance, like how can this play a role, like a positive role towards that?
Right. So, financial extraction, in other words, usury, is the original sin of both business and finance. From a systems thinking perspective, if we want different outcomes, it means we need to change the incentive structures. The only way in which we can change the incentive structures is by reducing, or better yet, completely eliminating the financial extraction out of business and finance. Businesses externalize costs onto both society and the environment because they are financially incentivized to do so. So in the case of businesses, I think that models like steward ownership provide a partial solution. And I say partial because steward ownership, their emphasis is on dividing, basically splitting profit rights from voting rights. My opinion personally is that there shouldn't be any profit rights at all. We can create foundation-owned companies that then hold 100% of the profit rights and also use a golden share to prevent an exit of that same company. Of course, if you try teaching this at a standard business incubator, people are not going to quite know what to do with this, especially given the fact that most startup incubators, that they're part of their own business model is reliant upon taking equity in their startups, and pushing them to grow exponentially and then to exit. And we don't talk enough about the financial conflict of interest in the startup ecosystem. Same thing in business schools. They get endowments by those who don't necessarily want the status quo to change. But what this means is that first, we need to churn out more little companies like Patagonia. And that's actually what I'm attempting to do with nonprofit ventures. I'm an entrepreneur myself. I'm running a 50-person cybersecurity company who has worked for, among others, Google, the European Commission, the Dutch energy grid, we've tested COVID apps for both the European Commission and for nation states. But at the same time, we do not-for-profit services at cost price on a zero-margin basis for nonprofits, NGOs, and civil society organizations. I visualize business as the most powerful form of activism. And I believe that if we eliminate the financial extraction out of business, then I think any company can become a pure vehicle for positive impact. But this is not the same thing as social enterprise, because the triple bottom line of social enterprise, people, planet, profit, the problem is that not only is profit always in conflict with people and planet, but it's that we don't even understand what profit means. profit has a double meaning that incorporates two aspects. The first is reinvestable margin, which is what I need to put into my business for stability and growth. The second part is financial extraction, which pays for my private jet and my Lamborghini. And not only is that harmful, also from a systems thinking perspective, but it is indeed even a competitive disadvantage on the market. Because when companies are leaking cash, then it means that's cash that you can't use for R&D, for paying your staff better, for lowering prices, and for providing better quality products and services. It's the same thing with the finance industry. We have ESG, environmental, social, and governance investing. But the problem is the E, environment, is far too popular. And that's because, one, it's sort of easy to measure, and two, somewhat cynically, because it is the easiest to greenwash with. Right? The S is a little bit less popular, but it's still a little popular because, you know, we want to fight poverty. That much is obvious. But the orphan child, the dust that's swept under the rug, is the G, governance. And almost no ESG funds are paying any attention whatsoever to the kinds of governance structures that, one, would take financial extraction out of finance, you know, so we can create non-extractive post-growth finance, you know, and also, you know, even just things like applying steward ownership, not only to portfolio companies, but also to the investment funds themselves. And I know that this all sounds extremely radical, but there are examples of investment funds on the commercial market that are actually doing this. One particular example is Snowball Impact Management from London. First of all, they're foundation owned, and second of all, they took their fee structure, the extractive 220 model, so 2% asset under management fees, 20% carried interest, and they reformed that fee structure to be the cost of doing business assuming middle class salaries and a pension. Imagine that fund managers might be only middle class, right? You know, limited partners need to understand that not only is this not risky, in fact, you're de-risking your investment here because you are eliminating the financial conflict of interest between the GPs and the LPs, but that it's less fees, which essentially means that at the end of the day, then whatever that fund is actually supposed to be doing, that it can, like, for example, stimulating impact businesses, that it can focus on that rather than focusing on enriching the fund manager. And let's face it, a huge percentage of the fund managers are the 1%. So we need to understand with finance, you know, in general, I tell startup founders to stay away from VC because, again, that extractive 20% carried interest, you know, it embeds the growth imperative into startups. If a VC gets 20%, if you do an exponential hockey stick and sell the company, that is a really powerful motivator. So what we need is brave fund managers who are willing to create non-extractive investment funds with steward ownership and reformed fee structures, so then those founders who do need capital have options. And we also need limited partners such as institutional investors and pension funds, but also family offices, NGOs, the whole range, to understand that the problem starts and ends with you, with the asset owners. So you are setting the tone for the entire market because you know, decide which fund managers to support. Those fund managers decide which companies to create. Those companies either externalize the costs onto society or the environment, and they don't. And this is the approach that we need to take to fix things. And with all due respect to, you know, I use the term post-growth a lot, but this isn't even about growth, because growth is just a byproduct, and the root cause of the necessity for eternal growth is financial extraction. So whether I think a company grows or it shrinks or it stays the same is, to me, not even the issue, but the financial extraction is. So what I personally would like is that we can start talking instead about non-extractive business and non-extractive finance, and understand that there are communities of real-life businesses that are doing this right now, today. In fact, when this session is over, I am running to a soundproof foam booth to talk to a cohort of 20 startups that want to, you know, that want to embrace such models.
Thank you, Melanie. Philippe. Philippe.
So you did it. You have a lot of applaud. I'm of course not as radical as you are, but I wanted maybe to just to build on this. First about the ESG. The reason why E is so popular also within asset manager is also because there is a strong link between E and profits today. Because it's really very easy to build portfolio with a positive E outcome, because there is a lot of innovation, which is good news, and there are a lot of entrepreneurs here, which are the proof of this. There are a lot of innovation in this space, and so there are a lot of investment opportunities. And so today, you can show that you have a financial performance alongside a very strong E impact, which is of course very difficult as far as the S is concerned.
Though, right? Like there are so many environmental strategies that need to be taken forward that don't have the high returns.
Of course.
And these aren't getting the finance. So we're all piling into the nice win-win, celebrating, patting each other on the back, but we're leaving on the side the really big transitions needed in the world of business because it's not meeting the financial parameters of the investors.
I mean, if you want to say that the big part of the finance and the economy is a carbon-intensive economy, I agree. I was just saying that the reason why ESG managers and impact investors are focusing on the E, it's because they are finding some opportunities in the E, and it's more difficult to find some financial opportunities in the S. It was just building on what you are saying. Second point about institutional investor. You are true. I just wanted to give you an anecdote. I mean, we are a kind of financial extractive asset manager, as you tell it. But we have decided to put a part of our carry in our foundation. So we have created Mirova Foundation, and so we have decided to put a part of the carry in the foundation, a strong part of the carry in the foundation. And so that means that the part of the carry which is given to the team is a little bit less than 50% of the carry. Okay? And we went to the European Investment Bank and the European Investment Fund in order to promote our fund. And the answer was, we do not want to invest in your fund because you give less than 50% of the carry to the team, which is absolutely a nonsense. It's absolutely, stupid. I mean, 40% is largely enough. You would like to decrease to zero, but at least 40% is largely enough. So that means that you are right. All the system and even the institutional investors and the public ones are pushing today to have to give more remuneration to the investment team, because they think that the more this investment team will earn money, the more they will be good, and it's called alignment of interest. And so, yeah.
Does that mean that then all this system is against us, basically, and there is no way of changing it?
There is a way. I mean, this is what we start to do, but at small scale. It's, I mean, just giving a part to non-profit is the first very interesting step. So you take a part of this carry, of this profit, and you give it to non-profit organization. Yeah. We start with 15%, 20%, because the market is organized like this. If others do 20%, then we will want to stay ahead of the curve, and we will do 30%. And then if the market do 30%, we will do 40%. So yes, there is a way to change this behavior, that's for sure.
Laura, if I can come in, I mean, I'm very excited by this conversation, by what you're saying, Philippe, what you're saying, Melanie, because we finally we are talking about the structures of business. Finally, we are talking about money. Sustainability is growing up. For 2 decades, I've been part of this world, and nobody talked money. The big boys talked money on the boardrooms, in the CEO lounges, C-suites. We're finally talking what happens to the profits. Ask that question every time you think a company is sustainable. Where does its profits go? Every time you see a company you think is doing well, who's on the board? Is nature represented? Are workers represented? Is supply chain represented? A company that has a supply chain, most consumer goods company, what prices are you paying? Are the prices you're paying enough for people to earn a living wage? Ask about these questions. They get to the structure, they get to the design, and this is exactly what we are working on. So if anybody in the audience, if you're a business, if you're a consultant, if you're an impact hub, if you're an incubator, a business network, if you want to run workshops to explore exactly this conversation, I invite you to go to doughnuteconomics.org, and we have a a tool to run a 2-hour workshop or a 5-hour workshop to have exactly this journey, exactly this exploration. What are the biggest, boldest actions we need to take that we are held back from currently because of the way we designed our companies? And what would be changes in the design we will need to make in our ownership structure, in our financial model, in the moving away from extractive finance that would actually enable us to do this?
Mm-hmm. Great practical step for our audience here to take. Philippe, would you have some, there are some investors here in the room, a practical step that they could take to help this change? I mean, it's very incremental change that you're describing, probably way too slow for many people who are listening today, but, you have to stay in what's possible, realistic, whatever. If some investors here are interested in taking the same path as Mirova or going further even, what would you advise them to do? Like just briefly, very briefly.
Oh, I think the important is exactly what you said. I mean, the important thing is that there is a kind of coherence between the investor and the investee. We have, and this is about impact investing, or maybe what you're doing is a step beyond. Yeah, we like to the way we interact with with the companies we invest in, and they have to want to have Mirova as an investor. Because we are going to push them and to help them to improve themselves and to improve their governance as well.
Great. Melanie, one practical steps for the startups here who want to take this path towards beyond growth entrepreneurship.
I think the largest practical step is to educate yourself. Look, if anyone is interested in getting more information or having a chat with me, please connect on LinkedIn. I have a lot of information available online, also on the Nonprofit Ventures website, including 11 hours of video, which is much longer than we have on this panel, because I'm teaching the post-growth entrepreneurship class at the University of Amsterdam, and this tells the entire story of non-extractive business and finance from the very beginning to the very end. There's many topics I wasn't able to cover today, including shareholder engagement, which is also another very large part of fixing this. But what I would say is if you want some more information, please reach out to me, and I can point you in the right direction. Thank you.
Thank you. Well, we're over time, so thank you very much, Melanie, Philippe, and Erinch for an amazing conversation. I wish we had hours to talk about this.
I wish we had Timothy with us as well. We could have pulled up a chair.
No, where is he? I don't. Well, anyway, thank you so much, and please a big round of applause for our speakers.
Thank you.
Thank you.